to other developments now. The record of the Debt Management Office shows that Nigeria's total public debt stock increased to 41.6 trillion naira in the first quarter of 2022, and that went from 39.56 trillion naira in December 2021. It's an increase of 2.04 trillion naira within a period of 3 months. The public debt stock covers the total domestic and external debt of the federal government and state governments, as well as the Federal Capital Territory. Now, according to the DMO, the total public debt stock includes new domestic borrowing by the FGN to partially finance the deficit in the 2022 Appropriation Act. The $1.25 billion Eurobond issued in March 2022, as well as disbursement by multilateral and bilateral lenders. Well, we've had this conversation so many times, but I mean, there are new developments, so we're back at it again. And this time we're having this conversation with Dr. Omobola Adu, investment research analyst with AfriInvest, joining us from Ikoyi here in Lagos. Hi, Omobola, good morning.
Good morning, Inia. How are you doing?
Great, great. So apart from this, I think one of the latest information in this area has been the suspension of the Eurobond sale that the federal government just did. Did that come out as good news, or is it just postponing the evil day?
Well, yeah, so this postponing of the about 950 million worth of Eurobonds that the federal government planned to raise within May to June is largely because of the current geopolitical situations that we are experiencing right now. If you recall, as at March, they raised around $1.3 billion in Eurobonds, priced around 8.4%. Since then, if you look at what has happened in the geopolitical space, the tension between Russia and Ukraine, we look at how central banks, global central banks have been hiking interest rates. We have a situation where the global economic environment is not that favorable to be issuing, particularly foreign bonds, when you take into consideration, right, that in terms of repayment, we have to repay these things in dollars. And you look at where interest rates are going, it means that our average cost of borrowing will be going up if we decide to explore the Eurobonds market as at this time. In terms of possibilities for what we are likely to see, I think the DMO already mentioned that they will be exploring withdrawing some of the rights with IMF in order to bridge the gap in the gap to fund the 2022 budget. So we're having a situation where I think the Ministry of Finance have come to the realization that our cost of borrowing is too large. If you look at in terms of our debt service to revenue, as at 2020, it was around 83%. IMF says that by 2026, we could be approaching 100%. So taking all these factors into consideration, borrowing at this present time, especially in the international markets, may not be the best may not be the best position for the DMO and for the government. So we should expect them to do more of domestic borrowing while also drawing down on some of the rights with IMF.
Yeah, okay, because I was going to ask, obviously we'll still have to borrow, because we have the deficits of the budget to fund. Will it be more beneficial to local investors, or will it help the economy better, or will it soften, you know, the issues surrounding the debts and debt servicing if this money is sourced locally?
Yes. So sourcing locally, in one, it's good for the federal government in terms that you don't need to start to look for dollars to fund repayment, things around repayment. So sourcing domestically gives you the leeway in terms of how you can repay the debt, because you are repaying with the naira, right? In terms of it being beneficial to investors, yes. So higher rates. If you look at within the last couple of months, the central bank moved to hike interest rates to 13%. And what we've seen in the fixed income market since then, treasury bill rates have gone up by an average of 90 basis points thereabout to around 4.5%, especially for the 364-day treasury bill. In the bond market, particularly at the mid to the longer end of the curve, we've also seen interest rates going up. We've also seen interest rates going up in the last couple of weeks. So we expect to see domestic investors taking advantage of this situation. In the last auction that the central bank did earlier last week, in terms of the 91-day and the 364-day, they were both oversubscribed by well over 4 times. So we're seeing domestic investors picking interest in the fixed income market, considering expectations around interest rates.
Yeah, well, if it does pay the economy, because local investors will, of course, boost their portfolio and it is cheaper for the government to repay, why does the government have to look outside for, you know, the dollar Eurobonds in the first place? What are the advantages?
Yes, so speaking to that, it has to do with our obligation, right? So we have Naira obligations and we have dollar obligations. There's no way you can fund your dollar obligations with the Naira. So that brings it to the sense that you need to have a good reserve of foreign currency. If we look at our external reserves over the last couple of months, despite increases in crude oil prices averaging around $100 to a barrel, our external reserves has been declining. We're seeing the deviations in the exchange rates markets within what we have in the I&E window to the parallel market. So this largely speaks to the situation where we have dollar shortages in the economy. And in order for you to shore up your dollar reserves, you might have to look elsewhere, especially when in terms of export earnings in terms of dollars, this hasn't been at a good level. Recall that oil revenue takes up majority of our export earnings, and over the last couple of quarters, we've seen oil production level declining on a quarter-on-quarter basis. We're not anywhere close to our historic levels, around 2 to 2.5 million barrels per day in terms of production, due to things around bunkering, things that are curtailing our production levels. So you're having a situation where we are not earning as much dollar earnings as we used to earn, and therefore the government has to source for this dollar, we have to source for these dollars from elsewhere, and that brings into the situation where we need to visit the international markets to issue debt in order to raise our external reserves. If you recall, in March, when we concluded the 1.25 Eurobond sales, our external reserves rose close to around $40 billion, but now it's currently around the level of $38 to $39 million in terms of external reserves.
Okay, still looking at the domestic scene now, the hike in interest rate to 13% from 11.5, have we started seeing the impacts?
Well, yes. So like I said, we've started seeing the impacts, especially in the fixed income market. If you recall, I mentioned earlier that the rates on treasury bills moved up in the last auction across all instruments. That's the 91-day, the 182-day, and the 364-day treasury bills. In the bond market, in the last auction they did, interest rates also edged upward. So we are beginning to see an adjustment in interest rates in accordance to the new monetary policy rate. If you also recall, as at last year, the central bank introduced a peg on the minimum savings deposit rate that commercial banks should offer at 10% of the MPR. So we expect to see, at the minimum, interest rates on savings deposit by commercial banks to move from the 1.15% we had earlier to around 1.3%. So interest rates in the markets are already adjusting to the new dynamics that we have in the economy as of today.
Yeah, one other thing that is relatively new in that space, the fixed income space, is the tax. Are investors reacting to that? It's not a discouraging factor.
From an investor's perspective, you have to look at it in terms of what are the alternatives that you have to invest in. The Nigerian financial market is not that deep compared to developed markets. So you have a situation where investors are constrained in order to either invest in fixed income securities or in the equity market. If we look at what the equity markets have been doing over the last couple of months, up around 23%, largely driven by some of the bellwether stocks. But if you look at it in terms of the overall broad performance, not all stocks are doing great. So it comes back to fixed income, right? So like I said, if you can imagine on a one-year T-bill, as at last year, you were earning around 2%. Now you can get as much as 4.5%. So despite the tax element, it's still a good investment to make on when you look at it on an average basis and you average out your cost of funding. So we should still expect to see investors play around in the fixed income market despite the tax element that the federal government recently introduced.
All right, so how does all of this fit into the DMO strategy, which is to increase debt threshold from 25% to 40%? Does this imply that the government still has more room to borrow without us being worried?
Yeah, so in terms of this indicator, right, when we look at the debt to GDP ratio, it basically speaks to solvency. But if the main issue always has to do with revenue. So your GDP doesn't pay back debt. It's your revenue that are going to use to pay back debt, right? So we currently have our debt to GDP ratio around 24%. But if you look at it in terms of debt to revenue ratio, debt service to revenue ratio rather, it's currently around 97% if you factor out grants and aids that the governments received within the last year. So at that point, it doesn't really speak room that we have more leeway to borrow. In fact, a rough estimate shows that for us to maintain a debt to GDP ratio of around 40%, we'll need our revenues to be hitting close to 7 to 8 trillion naira. Over the last 5-6 years, the best we've done in revenue is around 5.9 trillion. The government has a historical record of underperforming in terms of revenue, but always meeting their expenditure. So this, in terms of GDP, yes, it says that we have more room to borrow, but we have to look at it prudentially in terms of our revenue. Revenue is what we're going to use to pay back our debt. And based on revenue, having a debt service to revenue ratio of around 83-90% on the average doesn't speak well that we have so much room to borrow considering our revenue challenges. So it then boils down to, how can we reduce some of our expenditure line items in order to accommodate maybe more debts, that especially if these debts are channeled into economic generating activities that will be beneficial to the economy.
I guess the other side of that conversation will be, how can we increase our revenue so that even if we have to borrow, then our revenue will still be able to accommodate, servicing of the debt?
Yes, exactly right. If you look at our revenue breakdown, for a long time, we have been largely dependent on revenue from oil. But what we are seeing in the last couple of years, thereabouts, we are seeing an increasing proportion in the non-oil segment. So we've seen the Finance Act with government raising taxes on a number of items, adjusting the tax revenue base. So I think we're at the point and we're at the realization that we need to shore up our revenue. We need to look for ways to boost our revenues. But in terms of taxes and looking at where the economy is, we have to strike the right balance. Within the last 6 years, we've experienced 2 economic recessions. The economy is still very fragile. So trying to boost revenue or the non-oil revenue from the tax element might create more burden on individuals and companies. So at the end of the day, the government has to be more strategic in ways to boost revenue. But most especially, we have to look at ways in which we can prune down our expenditures.
All right, Dr. Mobola Adu, investment research analyst with AfroInvest. Thank you so much for sharing your perspective with us this morning. We do hope that one way or the other, these talks will help both to boost revenue and to cut down on expenses. Thank you so much and enjoy the rest of your day.